Good evening to everyone, to all the panelists and the delegates and the moderators. So we've had a very interactive discussion in the first half of our discussion on the real estate with regard to GST, RERA, accounting aspects. So I'm sure we need a clear-cut, probably a sort of summary in terms of a panel discussion where everyone is coming to the same page and talking about a lot of aspects which perhaps might not be as discussed in the first half, which probably need some time in our second half today. So with this, I would like to now invite our panelists and the moderator to the dais. First of all, I would like to invite KK Chapadia sir to please grace the dais. I request everyone to please give a big hand to every panelist who comes here, please. Next, I would like to call upon Advocate Rajiv Kanodia, sir, please. Ginoria, sorry. Rajiv Ginoria, sir, please. Next, I would like to call upon CA Rajarshi Das Gupta, sir, please. Now we have our very own EC member, CA Vivek Nevatia. Please, please come on the dais, Pia. And our very own, for whom I don't have to introduce actually to the whole house because everyone knows him, C. Arun Agarwal, sir, who has been kind enough to grace us. Thank you. So, now I have the opportunity to introduce all the speakers and make sure that we grace them properly with the relevant mementos. So first, KK Chapadia sir. He's a seasoned chartered accountant and insolvency professional with over 3 decades of expertise in tax advisory and corporate restructuring. He has advised several real estate entities in the Eastern India and has closely worked with the income tax department. He is known for his work on corporate amalgamations, demergers, and income tax cases, and frequently contributes to professional literatures and seminars. He is a regular lecturer at the NADT and has regular leadership roles in the various organizations, including Lions Club and professional study circles. He's been the past president of Views Exchange as well as past president of Lions Club. So, welcome, sir. And I would request, I would request Basant Gadia, sir, to please come and start here. Okay. Anup ji, if you can please present a memento to our esteemed speaker for the day. Next, to talk about Advocate Rajiv Ginoria. So, Rajiv Ginoria is an advocate having more than 35 years of experience as a senior partner in R. Ginoria and Company. He specializes in real estate, corporate law, and family and private client matters. He's a top scholar with prestigious awards, and he's known for his expertise in West Bengal's property tax laws. He's made significant contributions to CREDAI Bengal and various legal forums. He's also a member of legal bodies such as Law Society of England and Wales. His dedication to legal profession extends beyond practice, and as he actively participates in elite clubs and business groups, balancing his professional achievements with family and social commitments. So now I would like to call upon Aditya Dhanuka to please present a memento to Advocate Rajiv Ginoria, please. Now to introduce CA Rajarshi Das Gupta. Rajarshi Das Gupta, sir, is an executive director and National Head of GST at Aquilaw. He is an authority on indirect taxes, GST, and dispute resolution. He advises various multinational companies, state governments, and trade bodies on tax compliance and cross-border taxation. He's also a certified data privacy lead assessor, helping organizations with privacy policies and data agreements. Recognized as the leading professional of 2023, he has spoken at various professional forums like London School of Economics and served in various leadership roles with various tax chambers and professional associations. His chamber affiliations include CII, FICCI, BCCI, Indian Chamber of Commerce, ASSOCHAM. Now I would like to call upon CA Vibhor Tandon to please present a memento. All right. So I would like to call upon CA Sukrit Sinha to please present a memento to our esteemed speaker for the day. Now to introduce our very own EC member and a very knowledgeable person, CA Vivek Nevatia. Mr. Vivek Nevatia is a practicing chartered accountant and a registered valuer and a management graduate from University of London. He's having more than 17 years of experience in handling various assignments with diverse services in enterprise valuation, statutory forensics, and investigative audits, corporate financing, and business restructuring. Turnaround strategy, mergers and acquisitions, spin-off, negotiations of joint ventures, and the list goes on. He's currently serving as a special invitee in the accounting and standing board of NDAs and IFRS in various advisory group. He's also a co-opted member of the expert advisory committee of ACAE, and also he's a committee member of corporate and allied laws of EIRC of ACAE. So now I would like to call upon CA Vibhor Tandon ji to please present a memento to CA Vivek Nevatia. But, okay. So CM Manav Charchodia ji, if you can come and please present a memento. Now, to introduce our most important person who's going to moderate the entire session, CA Arun Agarwal ji and our very own past president of ACAE. So, Mr. Arun Agarwal is a CA and a professional prominent expert in indirect taxation, specializing in GST, Central Excise, Customs, VAT, and Service Tax. He's the founder of ARS Management Consultancy, and he's a director at multiple companies, including GST Cross-Border Solutions and Damdam Commo Trade. He's an influential consultant with national and multinational businesses, providing strategic advisory in both private and public sectors. He has been a faculty member for various training programs for revenue officials and is actively working with GST and Indirect Taxes Committee of ICAI. He's also a regular speaker and corporate trainer, delivering sessions on taxation laws across India. He's also an accomplished author. His books on West Bengal, VAT, and GST have been widely acknowledged. His contributions extend to media, where he frequently appears on TV and radio to discuss taxation topics. So, to present a memento to Arun sir, I would now like to call upon Sumit Bihani to please present a memento to our speaker for the day. So, yeah. So now I think we have a long discussion ahead of us, because we have a lot of views coming in from various speakers who are there on the dais right now. So we are all enthralled to have everyone here. So now I would like to hand over the proceedings to our moderator for the day, C. Arun Agarwal sir, please. You are requested to take forward the proceedings.
Thank you, Shubham. Friends, at the end, but as Anup was repeatedly telling me, people are highly interested in the topic of joint development agreements. So still we have enough attendance in the hall for the session, because we have luminaries on the subjects in their respective fields here gathered on the same stage to discuss this one single issue, that is joint development agreement. That one single issue has multiple issues that we need to unfold and probably again fold, so that people can go not confused, like Jais bhai said. Sir, जितना confusions आपने create किया है, अभी हमारे पास में luminaries galaxy of panelists हैं, वो सारे confusions दूर करने के लिए. तो but of course limited to the joint development agreement. Friends, since time is really very short, I wanted to stretch it by 10 minutes, but probably हम लोगों को चूँकि we are running late by half an hour, तो हम लोग को शायद 10 मिनट कम करना पड़ेगा. 1 घंटा 10 मिनट के बजाय अभी 50 मिनट्स में कंप्लीट करना पड़ेगा. So I would straightway come to the topic. Since joint development agreement, we were talking about joint development agreement. JSI was talking about development right, transfer of development right, and all those land and so many other issues he was talking about. So friends, in a typical development agreement, particularly in Kolkata, since we are all from Kolkata, so we know how joint development agreements are done in Kolkata. Sir, I would like to start with you actually, but of course the same question for all of you, that in a typical joint development agreement, where owner contributes only land, owner बोलता है कि भाई मेरा land है, developer बोलता है बाकी सारा responsibility मेरा है, यानी कि he will incur all the costs, he will take all the responsibilities, he will complete the project, and he will hand over. Now, either on area sharing basis or revenue sharing basis, as the case may be, but in such an agreement, whether at all there is any transfer of development right, because that from there all these issues come up or flare up. So, whether at all there is any development right getting transferred. And in this context, while in this context, I would also like you to throw some light on joint development agreement, that is a typical development agreement which we have vis-a-vis joint venture. What is a joint venture, and from that perspective, whether that will make any difference, or is there any clarity or confusion on that? So on that, sir, I would like to start with Rajiv Vinodia ji on the legal side.
Good afternoon, everybody. See, interestingly, there is no definition statutorily of development agreement. It is a nomenclature which has developed over a period of time because of the usage. Neither Transfer of Property Act, neither RERA defines what is a development agreement. And there can be various types of development agreement depending on what are the rights and obligations of the different parties. Again, whether there is a transfer of development right is there or not, that depends from two different perspectives. One perspective is the taxation perspective, and the other is the contractual and legal perspective. From the GST perspective, I believe there is a judgment of Pratiha Construction which says that transfer of development right takes place. That has been made by the Telangana High Court, and the appeal to Supreme Court has been made, but no stay has been granted as yet. So as of now, it is deemed to be a transfer development rights as far as the law stands today. But from the legal perspective, it's a different interpretation. Initially, development agreements were taken to be not granting any rights to the developer. The developer was not permitted to even ask for specific performance of the contract if there was a default by the owner. And there are judgments which were in favor of the owner against the developer. Gradually, over a period of time, the whole concept has changed, and now there are two judgments, one of the Supreme Court and another of Calcutta High Court, which says that a development agreement, depending on the nature how it is drafted, does result in creating an interest in the property in favor of the developer. And because of that interest in the property, the developer is entitled to ask for specific performance in case of default by the owner. So that's a very important right, which from the perspective of a developer is important, and as a lawyer, we try to create that right in favor of the developer. Of course, correspondingly, it can go against the developer insofar as the GST is concerned. But from the contractual legal perspective, it is important to include that.
Great, sir. Let me clarify, friends. This first round, we will have only 2 minutes each for each panelist, and we need to stick to that timeline so that we can complete the discussion. So I think Rajiv sir has already completed, adhered to the timeline of 2 minutes. Now, Rajasi, from GST point of view, since Rajiv sir has made a very important observation that it will depend upon the terms of the contract and responsibilities, but he also referred to the Telangana High Court judgment you are aware of, and you are day in and day out you are dealing with GST on development agreements, etc. Although the Telangana High Court, probably the issue was to be examined was not whether it is a development right being transferred, but probably whether it would be taxable or not. So from that viewpoint, sir, Telangana High Court said that it will be taxable under GST. But my question is whether at all any development right taking place, so for which you have also already answered in detail. Now what is your view on that, Rajesh?
Good afternoon, everyone. Thank you for inviting me. Just to take the cue from what Ginoria sir said, especially not from what the Telangana High Court said. The most important point is what the Calcutta High Court and the Supreme Court said from the perspective of the drafting. You see, GST and whichever law is all about facts, and I always tell the clients and everybody that law is 70% facts and 30% how you primarily interpret that fact. You see, in many a times in the JDA, it is joint development agreement, whatever is being drafted, there is a specific clause in the JDA which says grant of development right. You know, yes sir, if I am correct. So they are, irrespective of the fact whether that is what you say, revenue share agreement, area share agreement, there is a particular column or a particular paragraph, it says grant of development right, which primarily says that you have been granted the right to use that premises in your own will, which is not giving you the ownership, but the right to use the property for construction and development of that building, sell the building, whatever, at your own cost this. So, we have seen in multiple places that, and that irrespective of the fact in whatever term, and this even is a point in the last, in whatever way we have tried to change certain lines, some languages, so that what happens that how we perceive GST, so that it can help in case there is a matter arises, that there is a grant of development right, because it is all on a factual matter. Things are being stuck at the registration department, because if I recall correctly, there are certain lines and things they want to see or recorded in the development agreement, without which I guess there is some issue in registration. So in case there is, it is written that it is grant of development right in the JDA, it clearly from the fact itself shows that there is a grant of development right. But also on the other hand, that how from there you can write in a revenue share or area share, that how that can be protected, that becomes very important.
Correct. With that, Chapriyaji, I would come to you. I would repeat that, Vivek, Chapriyaji, I would come to you. And again, I would repeat that I am talking about a typical development agreement which you normally have in Kolkata, where the landowner is saying that my responsibility is only to the extent of contributing the land. That means my land will be used, my land will be there, and you as a developer will only construct. So your cost as well as responsibilities, everything is on you. I am not responsible for anything. Suppose if anything untoward happens tomorrow, that also would be your responsibility. So I am only my land will be used, and at the end of the project, when it is completed, say I will get 40% of the constructed area or 40% of the revenue, as the case may be normally. In those circumstances, I just repeat this. So in those circumstances, what has been your experience about whether at all any development right being transferred or grant, as Rajarshi said, and whether that is making any difference from income tax viewpoint for that matter? Vivek, I would come to that.
Good afternoon all. So coming to the direct tax incidence with respect to the transfer, I think the question which has been asked me, when the tax incidence arises. Okay, in order to answer that question, it is very important to understand first how the particular immovable property is appearing in the books of the landowner, whether it is appearing as a stock in trade or it is appearing as a capital asset. So if it is appearing as a stock in trade, in my view, at the time of entering of the joint development agreement, no tax incidence arises. So there is no transfer implications, because in that case, AS 9 will apply. So there is a significant risk and reward of ownership when it gets transferred. And my earlier speaker was also speaking on length on that issue. So when it is a case of a person which is holding it as a stock in trade, there is no tax implications vis-a-vis the transfer is concerned. Now coming to the assessees or the entities which are holding the immovable property as a capital asset, in that case, we have a specific section, section 2, subsection 47 of Income Tax Act. I just try to mention here there are 4 clauses which are quite important in section 247, wherein we can analyze when the transfer happens vis-a-vis the Income Tax Act is concerned. The first clause 1 talks about the sale or exchange. Clause 2 talks about the extinguishment. Clause 5 talks about possession in part performance of the contract envisaged under section 53 capital A of the Transport Property Act, and clause 6 talks about the transfer or enjoyment of the property, etc. So what is causing concern as far as tax authorities are concerned is clause 1 which talks about the word exchange, and clause 5 which talks about the word possession in part performance of the contract envisaged under section 53 capital A. Coming to your question, whether tax incidence arises when the joint development agreement is entered. Because there is an exchange, if you ask me, because earlier it was you are only holding a land. And typically in West Bengal, what I find, most of the JDA agreements are registered agreements. They are non-cancelable agreements. I mean, vis-a-vis the landowner is concerned, they are bound by that agreement. And so if that is so the department generally says that you have exchanged your right in the land with the right in the JDA, whether it is a revenue proceeds or the share in the portion of the land. So generally the department has a habit of perceiving that there is a transfer which has happened. And again, the department has a point to say that because of section 45, subsection 2, which says that if you convert your capital asset into stock in trade, then the tax incidence rises and the liability to pay tax comes later. So my point here is, coming to this concern, in 2021, there was a Supreme Court judgment in Sesasai Steels Limited case, wherein they have tried to distinguish possession. They have tried to interpret the word possession and said that possession does not necessarily mean physical possession. It talks about the word control, and control means, practically speaking, possession with an intent to give the control. So before I end my part, I would simply like to say the agreement need to be very, very properly drafted, and we can save the incidence of tax at the time of entering the JDA, whether you are holding it as a capital asset or as a stock in trade.
Very good inputs, Chapadia ji. Means in fact, on all the 3 inputs, set of inputs putting together, and the issue becomes really very interesting. Now I come to Vivek. Vivek, what has been like? Sir talked about terms of agreement perspective. He talked about again terms of agreement perspective along with the rights. Chapadia ji talked about treatment in the accounts and accordingly views taken by the courts from income tax perspective. Now purely from accounting perspective, of course again considering all these 3, what has been your?
Thank you, Arun Bhaiya. I think just starting off with a lighter vein, I think accounting is sitting this side, tax is on the other side. So that is the extremes which we are talking about from a real estate perspective when we talk about accounting and tax. And especially when we look at how Neeraj ji just spoke on the session on accounting for real estate transactions, I think it is very relevant to understand whether the company is following Indian GAAP or Ind AS. And when we are following Indian GAAP, the kind of accounting that is required to be undertaken is quite different from how Ind AS accounts for a joint development agreement. So as Mr. Ginodia pointed out, that we create an interest in favor of a developer. Basically, a right is created in favor of developer. And if the company is following an Ind AS basis of accounting, basically the fair value of the development rights which are acquired is now required to be accounted for an Ind AS accounting, which is then accounted for under the percentage completion of method basis the services which are rendered to the landowner. In Indian GAAP, that concept of fair value is not there. And so as soon as the development rights is even acquired, there's no accounting per se which is recognized. But as per the guidance note, we are required to evaluate whether the control is transferred and when the percentage of completion method or a completed contract method is required to be accounted for depending on the terms of the agreement. So for the purpose of companies which are following Indian GAAP, we really need to look at how the terms of the JDA is drafted to evaluate whether the company or the developer will follow a POCM method or a completed contract method to evaluate when the right control or the risk and reward is transferred. So that is, I think, very relevant, and again, the terms of the agreement become very relevant from an accounting perspective also, especially when a company is following Indian GAAP, also from an Ind AS perspective, but Ind AS requires a lot of analysis with respect to fair value accounting and also and as Neeraj also pointed out, on sale to customers on completed contract method, when the control is actually transferred to the customers. We have had a lot of detail. I will not get into the details, but of course there's a lot of subjectivity basis the agreement, drafting of the agreement.
Vivek, would you say anything about this JDA versus JV, joint venture? Does it make any difference, or how does it make a difference?
From an accounting perspective, JDA is very different from a JV. A joint venture is technically treated as a jointly controlled operation, and a separate Ind AS applies vis-a-vis a joint development agreement. So typically in a jointly controlled operation or a JV, we generally follow the equity basis of accounting, where we account for the net assets of the JV concerned in the books of accounts of the venturer. So there is a completely different set of accounting norms which are applicable with respect to how a JV or a jointly controlled operation is there vis-a-vis a contractual relationship which is created as a result of entering into a JDA. JDA, the relationship is more of a contractual relationship where the landowner is putting in its own obligations of giving the land to the developer for development, and the developer is putting in its own obligations with respect to developing the land for the purpose of onward sale to the customer. So the difference is between the contractual relationship which the JDA creates vis-a-vis a JV, wherein the two venturers coming together to form a JV, jointly controlled operation. So the accounting would be very different, and equity basis of accounting would be required to be followed.
Wonderful clarifications on JDA versus JV. Sir, I would just like to take one more minute from you. Like they were talking about that whether the control is getting transferred or not. So again, I repeat, the typical joint development agreement which we normally have, where the land continues to be in the name of the owner, the sanctions etc. are also in the name of the owners, and at the time of conveyancing as well, the owner has to sign as a confirming party, otherwise it is not getting transferred. So that means the land ownership at least continues with the owner, apparently, what I feel, and still builder is giving the right to develop the project, but the transfer cannot happen without the landowner. In fact, that is the point, or that is the area where I find at least that the Telangana High Court judgment was not not a complete judgment to my understanding. That is why it is before the Supreme Court. So on that, sir, what you would like to say on that?
See, it is quite true that the title does not transfer by virtue of development agreement. The title transfers only when the conveyance is made in favor of the flat buyers. The title remains with the owner till that time. In fact, in most of our development agreements, we write the clause that the granting of possession or the development rights should not be construed as a transfer under Section 247 of the Income Tax Act or under Section 53A of the Transfer Property Act regarding part performance. So that is specifically mentioned. In spite of that, the tax authorities interpret the document in different ways. So we are normally advising our client that after we have drafted the development agreement, they run it through the tax advisors, and in case anything is required to be modified as per their advice, keeping in mind the kind of structuring the company is doing regarding the property, whether it is stock in trade, whether it is a capital asset or whatever. So based on the specific requirements of the company, if something is to be written, we may modify the agreement on that basis before it is signed.
So, sir, basically that means your advice is, the bottom line is that for any project, for any joint development agreement, you should consult Ginodia sir first, then go to Chapadia ji, come to Rajarsi, again Vivek, and finally again come back to Ginodia ji. That should be the order, then only you can have a proper planned joint development agreement.
In fact, this is what is being actually done by most
Correct.
clients.
Absolutely. So that is the bottom line actually of this first round. Second round, again I'd come to the second round. I would again request to stick to 3 minutes each. Now, implications of area sharing model versus revenue sharing model. I am not going into the details of what is area sharing, what is revenue sharing, all of us know. So on that, and which one is more acceptable proposition, that means more advisable, more friendly, builder friendly or whatever from that perspective. So Raju sir, I'd like to start with you as to what has been your call on that from GST perspective.
Just to start this answer.
3 minutes.
Yeah, absolutely.
Rather, I would request Aditya Singhania to please check this 3 minutes time for each speaker.
So first of,
Please.
so first of all, to start this answer, the most important thing that I would like to state that to me, it is my personal view, that till date I believe that transfer of development right should never attract GST with any benefit arising out of a land. Because if land is out of GST or it is under Schedule 3, so any benefit arising out of a land, and there are multiple Supreme Court judgments and all, cannot also attract GST, but that's a separate thing altogether. One. Number two, coming down to this topic, is from a revenue share and an area share agreement. Revenue share primarily, in my view, generally a JDA should not attract any GST. While on the other hand, when there is an area share agreement, then there are notifications issued like 3 by 2019, 5 by 2019, 6 by, so, and it has to follow that somebody has to bill you the construction services, the developer will bill the landowner for the construction services, and landowner would not pay any GST, and primarily the landowner and the developer on the unsold portion will pay for the development right under reverse charge. Now the question is whether, which is beneficial. The most important point here is beneficial for me in case, always when if you think like that, in case where the developer has, if the property is being developed in a place where the land prices are much higher, like Park Street, Russell Street and all, where the landowner's portion is higher, to me it should always be an area share, because it is how you perceive a project from a perspective and how you compute input tax credit, because in construction services, there is no ITC, because whatever the people pay on the out product, which is 5%, you have to pay in cash without ITC. So whatever structuring you need to do is you need to do during the JDA period. So if your land prices are higher and your developer has, a landowner has a higher share, it is always better to do area share. On the other hand, if the landowner's share is lower, let's say the landowner is 30%, developer is 70%, eyes closed revenue share. Because you also need to understand from that how people should structure a JDA from a perspective of how much I would gain on a JDA, because as it is in a construction services, all my inputs are costs. So very simple answer that which one would be better at what point of time.
Okay, great. Aditya, you just follow them.
I hope I am within time.
Absolutely within time, because otherwise you will budge an alarm. Correct? Right. So now, sir, I would come to you again on that. Ginodia sir, from area sharing versus revenue sharing perspective, which one you normally suggest, and which is more builder friendly or?
See, from the drafting perspective, either is okay by us, but from the taxation perspective, clients come back and tell us that revenue sharing is better from them. From my perspective, as I look at it from the point of reducing the scope of disputes. From that perspective, revenue sharing is better, because in most of the projects, the selling is done by the developer. Now, if if the owner takes the specific areas, and the developer will be interested in selling his areas first rather than the owner's areas, that leads to disputes among them. Initially also there are disputes as to who will take which floor. A penthouse will get much higher price than the first floor flat. So all those aspects get completely very neutral in a revenue sharing, where in every square feet everybody is getting whatever she is entitled to. Even in cases where the owner wants to retain certain part, we do a mix where there's partly area sharing and partly revenue sharing. But ideally, I would suggest a revenue sharing model to be a better model from the general perspective.
Great. So that means Rajesh is saying that from tax perspective, in one situation, area sharing is more advisable. In another situation, revenue sharing is more advisable from tax benefit perspective as well as compliance perspective. Rajiv sir is talking about that from drafting or compliance perspective, both are equal, but to make it friendlier, that means to avoid disputes among the parties, it is more advisable to go for revenue sharing. Now coming back to Chapadia ji, sir.
Area sharing or revenue sharing, when it comes to direct tax, I always look at this where it is more advantageous coming to the tax part. Coming to advantage part, there are three issues which need to be checked. First, when the tax incidence arises, because transfer has a unique definition under the Income Tax Act. Second, under the Income Tax Act, it is not actually the taxation on the sale consideration, actual sale consideration. Sometimes there is a concept of deemed sale consideration as under 43CA or 50 capital C. And third point here is, what is the tax rates? Because in the capital gains, there is a separate tax rate, vis-a-vis in the business income, there is a separate tax rates. So we need to evaluate all the 3 points together to find out whether to enter into a area sharing agreement or a revenue sharing agreement. Now, coming to the practical aspect, many times a landowner who is having a big chunk of land, he is interested that once the building is constructed, he gets some flats out of that building. So naturally, a portion of that may be a area sharing agreement, and then for the balance part, there can be a revenue sharing agreement, depending upon the facts of the case. Second aspect is sometimes what happens, there is a landowner who wants that a commercial space is being built up, and he wants that ground, first, second floor, etc. need to be kept by him. So naturally, it has to be a area sharing agreement, because he wants to retain a portion of the land. Okay. Now, sorry, I can continue. No? So with that background, now I come to which one is the beneficial part and what is the tax incidence on that. First part is when I start discussing about the area sharing agreement. So in the area sharing agreement, when you enter into the area sharing agreement, as I was telling about section 2, subsection 47, as soon as you enter into area sharing agreement, you are changing the character of the land. From the land, you are changing the character to the right in the constructed area. So in my view, there is always a chance that tax authority will treat that to be a transfer within the meaning of section 247. So in that case, tax incidence may arise. But again, 50 capital D is the section which is very relevant here, which says that if the tax incidence arises, then the fair market value of the asset in question, I mean that land in question, that need to be set. It is not the stamp duty value, it is the fair market value. So we need to evaluate the mathematics and find out perhaps there can be a lot of tax savings on that front. That is one aspect. Second aspect, when it comes to deemed sale consideration. So when you enter into the area sharing agreement, so and that in that case, whatever is the, assuming the transfer happens on day one, so then the cost to the, in the books of landlord becomes the fair market value on the date of conversion. So again, he can take the advantage of capital gains, which is 12.5% now, or after indexation is 20%. Because if you enter into a revenue sharing agreement, then it may be very tough for a landowner to say that it is a capital asset. Vis-a-vis, if he is having a area sharing agreement, it becomes much easier to say that it is a capital asset. And third point here is tax rates. So now again, if at all a person is showing as a business asset, in my view, what I've been advising my clients, for a company, the tax rates is 22% plus, and for other entities, it is 30% plus. So try to make companies, or even if it is LLP, try to convert into companies so that tax incidence becomes lower. So this is as far as capital asset is concerned. As far as business asset is concerned, it makes no difference because as I told in my earlier session also, that no tax incidence arises at the time of entering into the JDA. I think I am within time. Thank you very much.
Thank you, Chapadia ji. I would come to Vivek now. That there is no rule of thumb, they are all saying. But now, how does it make a difference in accounting
So I'll
and
probably
reporting?
save on the time. Possibly from an accounting perspective, there's not much of a difference whether you go for an area sharing or a revenue sharing. Although when you actually look at Ind AS basis of accounting, there's some subjectivity which comes in if you have a revenue sharing arrangement. In terms of assessment of fair value, in terms of variable consideration standards, portion of the standards kicking in. So there is some subjectivity which comes in if you adopt a revenue sharing agreement. But again, accounting would be treated possibly, as Dheeraj pointed out, as something which is taken at last and not as part of the commercial considerations. So accounting would be mostly compliance and assessment and management estimates and judgments which would be required to be made basis the revenue sharing or the area sharing arrangement that is entered into. So I don't think accounting would affect how the commercial arrangement is actually drafted. So
Even for that matter, the reporting also would not be an issue? Or largely you think that there is parity?
So from an Indian GAAP perspective, honestly, there is not much of a difference whether you have a revenue sharing arrangement or an area sharing arrangement, according to me. From an Ind AS perspective, of course, the standards, the kind of compliances which you have to build in would be quite additional in terms of percentage completion method being followed for the landowner developer portion of the agreement, and project completion method being followed from a developer customer perspective. So that is where the two subjectivity comes in, and it's more from Ind AS perspective that the revenue sharing arrangement would be slightly more complicated to apply compared to an area sharing arrangement. But again, these would be estimates and Excel worksheets which required to be prepared rather than commercial considerations.
Friends, actually Rajarsi was telling me that whether, since so many discussions are taking place in so many different forums on these issues or these subjects, particularly say when it is an industry specific discussion on real estate, so different people may have different types of views, and here different streams of professionals have different perspectives. And on that, I am just thinking, when Rajarsi, when a GST officer looks at your balance sheet, and as I said earlier, that balance sheet is probably the first document where from they start, a GST officer. So Neeraj, don't think at all that accounting is at the bottom. Actually, it is at the top always. So when he looks at the balance sheet or profit and loss account, for that matter, whatever, the annual financial statement, and when he looks at the GST compliance, GST return, the figures reported therein, and when he tries to make a reconciliation, and mind you, he is a non-finance professional. He is a non-finance, not even a professional, I would say, rather probably it would be a little exaggeration. So a non-finance person trying to assess starting from balance sheet and looking at the GST return. So there, the reporting, accounting as well as reporting, and the transparency in the accounts, whether it is area sharing or revenue sharing, as the case may be, since there are different tax implications from GST perspective, and maybe to some extent on income tax perspective as well. So that becomes very important. So that we need to take care, friends. I just wanted to highlight that is very important, that where from the figures will come out from the balance sheet, and how do I justify that it was area sharing or revenue sharing, and that is why there is a difference in reporting, or what was expected by the tax officer vis-a-vis what actually the figures are. Rajesh?
The most important, sir, I absolutely agree with you, because when they look at the balance sheet, or why balance sheet, it is the financials. In the profit and loss, what comes for a real estate company is on the basis of completion basis. So it is not as per actual what is booked. It is actually how much you have completed. So it's completely different from what you have received, and based on which how you have done your returns. On the other hand, your advances in balance sheet, when it comes, it is completely different from the actual demand that you have raised. So if it is correct parity and reconciliation from an accounting perspective is done, that also helps, because the other side, those people doing the lower down whichever, and the scrutiny notices, these people they don't understand. They are people, we have seen people are not from that subject, and they are raising demands in crores just on the basis of what is actually reported. So accounts plays a very important role in how, what you primarily disclose in the notes to accounts, and the thing that what are the things that is there. So that is exactly, sir, I guess.
Correct, absolutely. Yeah, please. Vivek.
So just on a, again on a lighter vein, I think what happens in real estate agreements, मतलब as Arun sir, Arun bhai also pointed out, that गिनोडिया जी के पास जाते हैं, अपने agreement draft करवा लेते हैं, टैक्स डिस्कशन हो जाता है, जीएसटी डिस्कशन हो जाता है, फिर हेड ऑफ अकाउंट्स को बोला जाता है, देखिए ये अग्रीमेंट तो हो गया, दिस मिनिमाइजेज द टैक्स एंड कमर्शियली ऑल्सो दिस इज फाइन विथ अस, नाउ यू डील विद द अकाउंटिंग. दिस इज हाउ इट इज नॉर्मली डन.
Actually, now Vivek, I would complete the chain that accounting comes after the transaction. So always, so and before the transaction, these agreement etc. come. So first agreements, then transaction, and then accounting, and after accounting, then comes assessment. So that is why I am saying that accounting forms the base for assessment. So now the assessment will be done based on your accounting. That is why accounting becomes very, very important in particularly on these kind of complicated transactions on real estate, as Neeraj ji was pointing out. So that is very important, friends. Now come to the third round. Again, 3 minutes each. Aditya, please have a check on that. Now, what are the potential areas of dispute or controversy to be addressed in a JDA agreement? Potential areas of disputes. So I would again start with Ginodia, sir.
See, I think the responsibilities of the parties and obligations have to be clearly defined without any ambiguity. Some of them relate to even pre-construction things. For instance, in some cases, mutation is pending, conversion is pending, urban land clearing clearance is pending. Now, whether it's responsibility of the owner because it relates to the land, or whether it's the developer's obligation, whether the cost is to be borne by the developer, but the responsibilities is the owner, those things have to be clearly defined. Second is, what are the consequences of default or delays? That is very important. And third is the termination. Now, exit should not be easily available in a development thing, because a developer puts in his money, he puts in his name, and an easy exit for the owner should not be there. But at the same time, even the developer should have an exit if the land issues are such that exit is necessary. So one has to clearly define at what stages, in the minimum time when you can get an exit clearly on a fair term. It has to be win-win for both. So those default, termination and consequences are very important to define. And of course, the question of project financing also sometimes brings in problems, because the owner agrees to letting the property being given for mortgage, but he says, I won't give you the original document. So there has to be a clarity as to whether the original document will be deposited with the bank or not, even though the liability may be of the developer. So these are the primary areas of concern.
Okay, great. Now, Rajesh, from GST perspective, what do you think that the particular clauses or areas of dispute or controversy?
On this, I might cross my 3-minute barrier. I start with the caveat.
By half a minute?
Yeah. So, first of all, the most important thing is, if people are working on GST and people are aware, you see this particular thing, JDA, and taxability on JDA and litigation of JDA is not that tried and tested. 1. 2. If you go through the notifications, whatever notifications has been issued on real estate, 3, 5, 6, and it all generally speaks of somebody giving the land, somebody giving construction service, this blah, blah, blah. And it generally seems that it is on area share. When you draft, so primarily people when doing an area share, whether that's residential, commercial, generally people adhere to the GST laws and do it. When it comes to revenue share, it's a general notion, and we all follow what is revenue share? Is that, which is primarily the first question, that I come up with a land, or I come up with a property, you come up with your construction expertise, we jointly come together, and ideally, and there is an space, constructed space, which is being sold to a buyer. So it is nobody is providing services to each other. There is no economic benefit derived between the developer and the landowner. It is everybody is coming together to provide the final service to the buyer. So this is what is being perceived, and that is exactly the reason on a revenue share you do not, between the developer and the landowner, there is no GST which is being paid either on a construction service or a transfer of development right. But that's again not a tried and tested model till date, because we have a Telangana High Court going, which is gone to the Supreme Court, but because there is a major chance of dispute. Why? Because even in a development agreement for a revenue share, which we started saying in the first question, the word written is grant of development rights, sir, if I am correctly. So this would give the officers the first right to challenge the saying that, boss, आपका तो agreement पे लिखा है grant of development right, आप जो भी लिखा है economic benefit नहीं है, वो है, पहले वो समझाओ कि grant of development right कहाँ से है. So this is one major area of dispute which may come in. It is irrespective of the fact that whether people will win it, definitely we will win it, but there's a dispute. Another point of dispute is, in many a times in a JDA, even if there is a revenue share, there are issues that subsequently in a supplementary agreement or kuch jagah pe aake, some jagah pe there might be an area share. बहुत जगह पे हो जाता है कि no, yeah, because subsequently, because of whatever, might be the development agreement was entered original in 2017 for whatever reason. This project started in 2022, and at that point of time the land prices have gone up. So just to give some benefit to the landowner, he said that I will give you 5 flats more or something, this, that. There is some area share. That creates another option. If there becomes a hybrid model, then people takes that the entire thing is an area share or something or the other. So that is another point of dispute. Last but not the least, another issue which is there, if a JDA is entered prior to 2019 and that project continues post that, because whether one, that rate has been changed or not, if changed there is a problem of anti-profiteering, whether you have reversed that opening, closing stock or not. So to me, these are the issues or things which come up in a JDA.
Very good, Rajosi, and thank you for adhering to the timeline again. Now, Chapriyaji, I would come to you on this same issue. I will not repeat again.
This time I think I will take lesser time than what has been allotted to me. Now, 3 points or 4 points which I think should be basically incorporated in the JDA agreement to not to have the tax incidence on the date of JDA. I think Ginodia ji has talked a bit upon that, but I'm just trying to repeat the same. Once, there should be clearly mentioned that developer is acting on owner's behalf. Number 2, it is the developer's right to have the position, it is license under section 52 of Easements Act. It should be clearly mentioned in the agreement. And third, no right or interest is proposed to be transferred, and the JDA should not be considered as a partnership within the meaning of Indian Partnership Act. So these 3, 4 clauses should be there. But before I end up my session, as far as JDA, because my question is specifically what are the points should be there to avoid the tax incidence at the time of entering the JDA, so that's why I gave 4 or 5 points. One thing which I would just like to discuss upon, which I have personally advised my clients also. Many times the clients are having agricultural land which is not a capital asset within the meaning of Income Tax Act. And as you will appreciate, when so it becomes sometimes very important that we convert that capital asset into a stock in trade much before the JDA is entered. So, and that conversion can happen at a fair market value, not the stamp duty value. And so the incidence of tax goes away as far as the value of the fair market value when you convert your capital asset into stock in trade. I'm just giving a hypothetical example. Suppose the land value is say 1 lakh rupees and the fair market value on the date of converting into your business asset is say 50 crore rupees. So on 49 crore rupees, you will never pay any tax. Now, how can you do that? So if it is an individual, you can make a self-attested affidavit. If it is a partnership firm, you can make suitable changes in the partnership deed. And if it is a company, you can do something of that. So there are other issues also which need to be taken care when you enter into before you enter into JDA. But since my question was very specific with respect to the disputes which may arise, so I'm concentrating my session on that only.
Absolutely. Vivek would.
I just want to clarify one point. The Indian Easements Act has not become applicable to West Bengal because the notification was never issued. There is a judgment to that effect. So we need to call it a license but not refer to the Easements Act because in West Bengal it's not applicable.
That's a very good input, very valuable input. Now, Vivek.
I'll not take much time, but from an accounting perspective, what I can think of is the clarity on the timing of recognition. So one is, of course, the agreement that is entered into from a joint development agreement perspective. The timing of recognition on when the developer acquires a development right or when he actually gets the interest in the development right so as to start the work. That commencement, that timing of recognition on when the accounting should be done is very critical. So if that clarity is there in the agreement, it really helps. Second is, of course, on the breakup of the consideration with respect to how the consideration allocation would be done amongst the various components of the services which the customer is receiving. Could be on account of car parking, could be on account of the flats, could be on account of various services which the customer enjoys. So that breakup of consideration is very important. And also the liability clause needs to be very well worded. In terms of, I should be able to identify if the project is delayed, how much of the potential liability that the developer or the landowner is liable to pay or receive. So that really helps on putting in the right estimates when the accounting is done. So if the project is delayed or if the project is, if the developer is not able to conform to its obligations, that really helps in identifying the right amount of provision that is required to be created in the books. And of course, when we are looking at fair value accounting under Ind AS between the landowner and the developer, again, the clear specifications of the building as to what would be the FSI that would be received, the FAR which is there, how much of it would be allocated, how would the additional FAR be allocated between the landowner and the developer are again critical considerations from an accounting perspective, which needs to be factored in when the accounting is done. So I think these are the 4 or 5 points which are very relevant.
Very good, very good inputs, Vivek. Sir, I would come back to you and Rajasi both on this again. One is, like Rajasi was talking about hybrid agreement. So hybrid means under different circumstances, 1 or 2 he mentioned. Like, don't you think that every agreement actually is a hybrid agreement in a sense that suppose even if it is a revenue sharing, but at the end of the project, suppose 80% or 90% is sold, then what about the balance 10%? Maybe there would be a clause that for next 1 year or 2 years also they will again continue, the builder will sell and share the revenue, but suppose after the 2 years period as well, some 10% or 5% still unsold stock remains. So then ultimately it has to be divided between them. So then it becomes an area sharing. So how do you take care of that?
See, all the development agreements provide that if they are revenue sharing, they provide that unsold areas after CC, what happens to that? Usually a 6-month period is mentioned that post CC for 6 months, the parties will continue trying to sell together, the developer will keep doing the same. After 6 months, in some cases 12 months, the unsold inventory is divided between the two, and at that stage we provide that the owner must pay the GST applicable on the owner's share which is allotted to the owner at that point of time. That is what we are doing currently, because at that point of time it becomes an area sharing situation.
Rajesh, I would come to you on this to the extent that as you were mentioning about tax implications on the areas to be taken care of, especially one area of dispute I am just trying to put on which probably you did not address, that is regarding when, as you initially said, that development right or for that matter grant of development right in this kind of typical agreements is not at all taxable. That is one view definitely, but largely general view, accepted view is it is a transfer of, as if it is a transfer of development right or grant of development right, it is taxable and accordingly tax is being paid. And when tax is paid under GST, one is builder is, owner is liable to pay on development right being transferred to the builder, and builder is liable to pay to the extent of construction services provided to the landowner, to the extent of area shared. Now on that clause, whether GST is at all payable, if builder is liable to pay, whether he can recover it from the owner or it will be from his own share. On those agreements or on those clauses, sir, are there any disputes or what do you find from GST perspective? That is my point to both of you, sir, again.
First of all, nowadays on the JDA, it depends that I am representing whose side, whether I am representing the landlord or whether I am representing the developer. Let's say on the unsold area, generally and if I am representing the developer, so on the unsold area, we mentioned that in the event there is, if any GST which needs to be paid by the developer under reverse charge, then the landowner will be liable to pay to the developer on such account, these and that. So we generally get write a reimbursement clause which forms a part of the JDA, though that in any which sometimes in a revenue share sometimes becomes a little detrimental, but still for the purpose of protection in the agreement we mention that. But another thing, why when you are talking of hybrid model, and sir, when we are mentioning that on the unsold area, when there is a division of the area, which so here many a times what people think that because post CC, since there is no implication of GST on the sale, and I am just taking an individual's area, whichever people will sell. So they are of that notion that under such circumstances GST would not be applicable. So no other things should come in, which again might be is an area of dispute, which you have correctly pointed out. So in my view, these are the two things which you were ideally pointing out. I thought of addressing.
Correct. Sir, how this point is addressed in the agreements largely or earlier or vis-a-vis nowadays, do you think there is any change or any in this situation that in your drafting, etc.?
See, from the developer's perspective, the developers are wary that they don't want to be saddled with a cost, because ultimately the GST authorities will take the payment from the developer. So he must have the ability to recover it from the owner. So we provide in the agreement necessary clauses to say that in case on any part of the transaction, GST is payable other than what is payable for the sale or on the construction part, that the owner must contribute and reimburse if it is payable. We don't say it is payable, but if it is payable, he is liable. If the owner is liable, that is how we provide for it.
So same for the other side as well. That when
see, nowadays one has to be fair in your drafting and in your these things, and it has to be transparently done. Because it's not very easy to just slip it through something and hope that the owner will not understand it if you are from the developer side. So even if you are either side, you have to take the bull by the horn and decide and make them agree to whatever is the correct thing.
Correct. So from both sides, if there is any contingency on account of tax liabilities, so that needs to be taken care of at the beginning itself while drafting the agreement. Correct. Fair enough, sir. So with that, we come to the end of third round, and the last round, friends, on that again, 2 minutes each I would like you to devote. That is, what are the areas where you think there is need to align the laws with the needs of the real estate industry? Laws aligned with the real estate industry expectations or requirements to avoid disputes, etc. So starting from you, sir, again.
See, of course, besides the procedures for conversion and ULC, which are very important because they are a big hindrance to development and to the real estate sector, they need to be streamlined. Particularly ULC has to go. People are forming 200 companies, 300 companies to do big projects, which is not good. Second aspect, which is important, is the question of parking. There is a lack of clarity on the issue of parking in RERA. They talk about enclosed parking with walls on 3 sides and the roof. The practical part is, what about stilt parking? What about podium parking? What about mechanical car parking? In Calcutta, there is no clarity. In Maharera, they have issued a circular saying that you cannot sell open car parking, even if it is sanctioned. For no consideration, you must do it. But in case of a stilt and all, it is taken as garage, which is not the law, but that's how they've interpreted it. In Calcutta, we have the system where when you go for registration, you have to give value of the car parking separate, which is not, although we are not charging for the car parking separately. So that has to be aligned together so that the dispute is not there.
Very good input, sir. Very valuable inputs, I would say, because very pertinent issues all these three are. I would come to Chapadia ji on this.
Regarding the proposed alignment of laws, see, one is 50 capital C or 43 CA. What happens if the transaction value vis-a-vis the stamp duty value is different, then there can be tax implications. And what tax implications situation can be ascertained at the time of assessment proceedings only. At the time of assessment proceedings, we have a right as an SSC to refer it to the valuation cell. I was just trying to find out if something need to be aligned. Is that valuation thing, why can't it happen at the time when the deal is materialized, so that the assessee can know exactly what is happening, so that the return can be filed accordingly, rather than waiting till the assessment, the assessee is in the dark. That is one aspect. Second, section 45, subsection 5, capital A. If you remember assessment in 1819, what happened? There was always a dispute when the transfer happens in case of a landowner, whether the transfer happens at the time of entering the JDA or etc. etc. In order to remove that litigations, section 45, subsection 5A was introduced, which was applicable only for individuals and HUF. And it said that if an individual or HUF enter into a joint development agreement wherein the individual or HUF get a share in the project, I mean, it should be a area sharing agreement. In that case, the tax incidence is deferred till the date of completion certificate is being issued by the competent authority. But the chargeability of the tax, even if it is capital gains, the chargeability of tax comes at the stamp duty value which is applicable on the date of completion certificate. Now the challenge comes. In 43 CA or 50 capital C, we have a right to refer to the valuation cell. But in 45 subsection 5A, we have no right to refer to the valuation cell. So in our institute's memorandum, also in pre-budget memorandum, we have suggested this point, that this should be brought in there in 45 subsection 5A also, so that we have a right to refer to the valuation cell as far as 45 5A is concerned. Lastly, in line with the SSI Steel's judgment, the position word should be clearly defined. It should, because in subsection 47, clause 5, it is only using the word position. And tax authority still interpret that position means the transfer. But SSI Steel's case 2021 judgment, Supreme Court has said that position should be interpreted not in the method of physical position, but in the method of the absolute control mechanism. So that need to be aligned in the act so that there is no controversy with respect to the incidence when the tax incidence arises. I think these are the three things which we need to align.
Okay, very good input, Sapadi. Coming to Rajarsi.
So, in this, I would like to take the cue from what Ginoria sir said. In the first point, when we were discussing on which is a better, second point, revenue share, area share, and now when sir said that aligning of the RERA laws from the car parking and all. So, first of all, the most important point is, you see in West Bengal, since we are only catering this entire, or we are restricting to Kolkata and West Bengal, the major problem here is in an of realigning RERA with GST. Why? First of all, when GST refers to RERA, and they have borrowed all definitions and everything with RERA, under RERA, promoter means it is developer as well as the landlord. The definition of promoter says. But when you go for an area share arrangement and you go to RERA to get a registration separately for a promoter and for the landowner, it is one of the most difficult job in Calcutta to get two registrations for the same project. Because it is extremely difficult, and I think sir will agree on that. And that is one of the major reasons why developer, irrespective of the fact they could understand that area share might be easier, better for them on structuring, they go on to revenue share, because in case there are two buildings, building one, landowner, building two, and they are also who will take care if anything happens to the landowner's share, developer would not take responsibility. A lot of issues come in. This is one. So irrespective of the fact in law, there is reference to RERA, alignment in West Bengal with the GST laws of RERA is very important, and same with the car parking, because those open air car parking, all these things, GST takes a different view, because the land, this entire value includes car parking, wherein I give you the car parking on lease, this, and there is a lot of disputes, and this needs to be settled. Number two is also, when we are talking, half a second, we are talking about development agreement, wherein, which goes for registration, if I primarily from a GST perspective draft that two people coming together to give service to a buyer, no, yeah, all these things, not clearly mentioning grant of development right and bypassing this, here they would not register the agreement, because you need, they see certain words, only then they will register the agreements. Those things, those realignment of different laws needs to come in at one point of time. So this is my humble thing.
Very good, very valuable inputs. In fact, Rajasi, again, very pertinent points you have mentioned additional to what they have already talked about. Now, Vivek, just I wanted to remind that if there is a development agreement vis-a-vis joint venture, as you also explained in detail earlier, there are different implications under GST, under income tax. It depends upon the terms of agreement as well. Then if it, whether it is area sharing or whether it is revenue sharing, all those will have different implications, and terms of agreement is also very important. And then finally, tax assessment is to be done by the tax authorities, particularly GST. They are absolutely non-finance people, but assessing based on the accounts. So from that perspective, do you think that Ind AS or guidance note, whatever are available, are that sufficient to make it aligned to the GST assessment or income tax assessment for that matter? Or if at all, do you think, you are in the advisory committee as well, do you think that some new or some evolving literature is required from the perspective of RERA and GST and income tax? Although I know you will say that you are not an expert on RERA or GST or income, and RERA or GST particularly, but still you could understand the tax implications. So do you think that any new initiative is required from that perspective?
A lot of clarity is required, in fact, sir, on the standard setting, on how the estimates are required to be made, on how a particular arrangement is looked at as from a JV perspective or a joint or a JDA perspective. There's a lot of clarity which is required to be made. But when we look at real estate players in the industry across, I think we would like to keep it vague. And that is how it has been the practice throughout. Income tax would like to defer the tax. GST would again operate at a different perspective. As accountants would like to show our profits as early as possible to ensure the bankers are happy. And it's a very different set of expectations from each of the tax heads or the accounts heads or the finance heads or the legal heads are there. And these would be very differing requirements. And as industry players also, if we look at discussions with the industry players, they would say that it's better to be vague than specific. And that creates a big challenge. Although we as accountants would probably push for certainty and alignment of the different laws which are there. But as we all say, the auditors may be slightly more prudent, but as accountants, we are always flexible to account the way the commercial considerations are made. So that is something which
I would like to add an interesting fact on the point which Rajshri raised. Registration of the same project by the owner and the developer on area sharing basis is actually very difficult. I've gone through the experience, and ultimately we got registration in a funny way. The name of the building had to be changed. So the developer's portion is called so-and-so Vistas, and the owner's portion is called so-and-so Vista. So now flat number 1B is in Vistas and flat 1A is in Vista. So
because on that same project we have also worked. And more interestingly, they have said that put a hash, put a dash. So I know the most interesting thing, when you do a registration, and for the same thing in a RERA registration or even the seller's registration, same building is sunflower dash or sunflower. And this creates more issues. But who is sunflower and who is sunflower dash? two people residing just next door might be of sunflower, the next flat is sunflower dash.
Same thing actually probably Anup is also doing sometimes that अरे दूसरा e-way bill निकालना है with the same invoice number तो अब वो निकलेगा नहीं तो वहाँ पे dash बैठा दो या hash बैठा दो. So this is how our regulators actually working, but Vivek has made a very important point that ultimately probably it is going to remain vague. That means clarity is actually probably we cannot really expect clarity because of various reasons, because of multiple reasons, because of multiple compelling situations. So that brings us to the conclusion. Jayez bhai said that confusions, we need to create confusion. That means everyone knows that actually confusions are going to remain, confusions are going to continue, new confusions, new clarifications and further new confusions. So with this friends, that brings us to the conclusion that we actually need a industry specific policy, real estate industry specific policy, where first government should come out with a real estate specific policy and then align all the laws with that policy, so that suppose sale, so it is sale, whether it is income tax, whether it is transfer of property act, whether it is GST or whether it is accounting for that matter. So similarly, if development right is to be treated as sale or whether it is to be treated as a service, whether it is to be treated as a capital asset or whether it is to be treated as a stock in trade. So the different laws are not aligned to make the industry compliance friendly. So that is the probably bottom line of the discussion. With this friends, we come to the end of this particular panel discussion, but at the end, I think if time permits, we can take 4 or 5 more minutes to take some questions. Yeah, 1 or 2. We can start with Anup and then Neeraj ji. Absolutely, sir. For any policy, stakeholders' participation is most essential. Probably in last few years, my experience that stakeholders' participation is missing. Earlier, I have seen that continuously for any new, any changes in the laws or amendments or policies, stakeholders have always been made a part of those, correct. But recently, in last 10 years probably or so, that to my mind probably is missing. With yes, Anup.
Thank you for all the panels for the great burning session on JDA. That is a very burning issues. But say accounting, आज panel of experts said about Ind AS करना है क्या फेयर मार्केट वैल्यू करना है, इसका डिस्क्लोजर करना है, परसेंटेज ऑफ कंप्लीशन मेथड्स करना है. बट द प्रॉब्लम इज दैट जीएसटी पीपल डू नॉट अंडरस्टैंड व्हाट इज इंड एस. आपको हिस्टोरिकल में करना है, परसेंटेज ऑफ कंप्लीशन में लेना है, उनको एक ही मतलब है कि आपने ट्रांसफ़र किया, आपको इस पर टैक्स लगाना है. सो फॉर द फाइनेंशियल स्टेटमेंट्स हाउ द दिस थिंग्स विल कम अप, it should be very in clarity. Suppose we are going for the JDA, correct, and we have entered for the area sharing, correct. Balance sheet will not reflect this kind of things, grant of, right and all. So there should be some mechanisms or policies, especially for the GST actually, so that a businessman can run the business smoothly, because and the professionals can explain the case, and the departmental officers, most important, can understand, because here the industry are getting the problem actually. So that is my things that should be taken up, and that is very important, because it is very important for the business perspective also.
So I think Vivek has already addressed that, and don't worry, Vivek is a part of the expert advisory committee of ICAE as well, so he will take it up in appropriate
thank you.
the best possible.
But one is car parking issues. About just I wanted to know from the panel of experts, in the agreement, the car parking
from any specific
no sir. In the agreement, suppose some agreement is drafted, car parking is given in the agreement and not given in the agreement, separately sold. Lot of litigation on that. How it will be dealt actually?
So it is a GST.
So
Shapadia ji will address, or Ginodia sir will address, or who will address?
Ginodia sir can address, sir. GST part I am talking about.
On the GST, I think he's the right person to answer. On GST, the other aspect I could have answered.
So, from a perspective of car parking, there are 2-3 things. If it is affordable, then you please understand that the value of the car parking should form a part of the value decided under the notification. Other than that, if it crosses it, it comes under a normal scheme. So if it forms a part of the agreement, then there is no issue. in case it does not form a part of the agreement, comes the new issue. Whether it is car parking is whether that is a sale of land or not. Whether that is one. Or whether it is sale of developed land or not. Few days back, people said that sale of developed land is out of the purview of GST. Now they will say that no, this is not a sale of developed land, it is a form of service that you are selling, providing in the form of car parking. Again, whether that will come under the purview of GST or not. Now, how you primarily frame that agreement. Now, if that car parking is leased out, then creates another issue. Because if it is leased out in the form where there is one rate, because over 30 years there is under income tax, you have a stamp duty, it is treated as sale under GST, then over and above they will, even if the problem is, the moment it becomes leased out, your normal rate it will be 5%. If it is leased out, it becomes 18%. So it depends how, again I come to Ginoria sir, that how the agreement is framed.
See, in the agreement, we do not say sale of car parking, we say right to use. So whatever is the implication of GST will depend on this language. There is a gray area about saleability of car parking spaces because garages, which all three sides are not there in today's world. They are all stilt parking or basement parking or mechanical parking. So we use the term right to use or car parking facility. That is being transferred, not the land, not the car parking space. So it can't be treated as sale of land. It has to be treated as a facility or a right to use. So I think GST would be applicable.
So again, the most important point is that which sir says right to use. So now if it is a separate arrangement, not a forming a part of the, if it is forming, it becomes a composite area. So that people can still take a stretch view that it is composite. The principal part is the your building and it is incidental to the building 5% or 1% as the case may be. But if it is separate, then you see you have bought the building at 5%, right to use it is 18%.
So Anup, it was out of syllabus, but still it continued. We will not have any more out of the syllabus. But more importantly, as sir said, the terms of agreement and all, apart from that, most important probably is the RERA definition of garage or car parking. From that perspective, as sir already pointed out, that definition in RERA, then treatment in stamp duty and GST, there is no alignment. So that needs to be taken care of. That is one subject which is actually open. Sir, you had something to.
No, so only quick comment, and I think. I think Ginodia ji very correctly said about the term used in the agreement, right? And I can tell you my first experience with such kind of arrangement was back in 2010, right? And the life has changed a lot after that. And the terms can have significant impact across all the three verticals. We heard accounting, we heard income tax, and we heard GST. You know, the concept of transfer stroke control is very, very important. And that's how you actually play with words. And lastly, I mean, just on a lighter note, I will use the analogy, which is actually good for us. एक ऐड में एक टर्म थी दाग अच्छे हैं, right? So I think I would say confusion अच्छी है because it all helps all of us. So thank you.
So with this, friends, I think no more question. So we come to the conclusion of the session and conclusion of the day-long summit. Thank you very much. Now I hand over to organizers.
Once again, sorry, I would like to request everyone to give a big round of applause for the panel. I think we've had a wonderful discussion today. I think so many aspects with regard to real estate, we usually don't foresee that the implications can be so huge for any small treatment, be it the smallest of issues with regard to TDR, be it car parking. We've had multiple areas of discussion today, so I'm sure everyone has been thoroughly enlightened by the amount of aspects that we have covered today. So I would now request Aditya here to give a formal vote of thanks to all the panelists who've been kind enough to grace the occasion too.
Thank you, Shubham. A very good evening, ladies and gentlemen. As we come to the conclusion of the session on the Joint Development Agreement, it is my honor and privilege to deliver the vote of thanks to the esteemed panelists. Firstly, I would like to give a vote of thanks to CA KK Chapadia sir for enlightening us on the intricacies of the income tax, to Advocate Rajiv Ginodia sir for shedding the light on the legal perspectives, and CA Rajarsi Das Gupta for his valuable insights on the GST implications on the JDA, and to CA Vivek Nevetia for his detailed explanation on the accounting and audit perspectives. A special thanks to our esteemed moderator, CA Arun Kumar sir, whose adept moderation has kept the discussion to the point and has made it focused and insightful for everyone, and as well as it has made the session also very fruitful for all of us. I would like to express my sincere appreciation to the ACAE and the CREDAI West Bengal for organizing this incredible platform that brings together thought leaders, practitioners, and industry experts. A big thank you to our sponsors, Godrej Properties, Doctor's Choice, Magna Star, and Eden Reality for their unwavering support in making this event a grand success. Finally, to all the participants and the delegates present here, your presence and active involvement has been instrumental in making this summit meaningful and impactful. With that, I bring this session to close, hoping that the learnings from the today will help us in making the informed decision. Thank you, and I look forward to joining and seeing you all in future programs organized by ACA. Thank you so much.